Hello. This course is for all traders, whether you are experienced or whether you are beginner. This course will my objective is to make you a good trader, a profitable trader. So I will guide you, and first of all, you have to go to Google and search Master the Markets book, written by Tom William. This book is written by Tom William. Okay, so process is just go to Google and just type Master the Markets PDF, and you will get this book. Okay, I will share I will share the link in the description to download this book. You have to read this book in order to start. Okay. To be a successful trader, you should have a method. Okay, without method you cannot trade profitably. So you should have a method, and then you have a strategy that will help you to play market from buy side and sell side, whatever market present to you. Okay, now you have to read this book 2 to 3 times. Master the Markets. Okay, this is written by Tom William, maybe 1993 to 2009, and they actually market their trade guider software. We don't need any software. In order to trade the market, we just need a trading view or an MT4. We don't need any fancy gadget or software like trade guider. So by reading this book, ignore the word trade guider or anything related to trade guider. You just have to ignore it. Just read the book and get the concept out of it. Okay. This is the contents covered in books: market basics, and then trends and volume spread analysis, and then third section is anatomy of bull and bear markets. Then become a trader or investor, section 4. Then you have a section 5, trade guider system. You don't need section 5. You have to read this book till section 4. You don't have to read this trade guider system. Okay, ignore this part of the book from 122 onwards. You don't need that. Okay. So let's start. Now, in order to be a successful trader, you should have a method. There are many methods. Let me name them, like Elliott wave method, price action method, order flow method, smart money concept, SMC, ICT, inner circle trader, and many other methods like Elliott wave, like a market profile. There are different methods in the market. What I am going to introduce you is a method that we call it volume spread analysis, VSA. In short version, we call it VSA. So it is a method to deal the market and to pick the market top pressure points to take to buy for to judge the support level of the market for buying and resistance level of the market for selling. And this trade guider, ignore that. Now you will go through all this. Okay, and I told you already that this trade guider software is nothing. Don't ignore it. Now a third paragraph, second paragraph, this book is actually a foundation course of volume spread analysis VSA methodology, which is a multi-dimensional approach to analyzing the market. VSA is actually a way of dealing with the market, a method. And what we do in this method is we use price mean candlestick charts. We use spread, size of the candle. Spread means size of the candle, high and low. Difference between high and low is the spread. And we use the volume. We use these 3 points in order to trade the market using our method volume spread analysis. And we just need these 3 data elements: price, spread and volume. Now in order to have a correct analysis of volume, one needs to realize that the recorded volume contains only the half of the meaning required to arrive at a correct analysis. The other half meaning is found in the price spread. Now price is the half information. If you combine with the volume, then you will get the total idea out of the market. Like if you're reading the market price chart like candlestick chart, you are actually reading the half information of the market, because below volume is the major indicator, and that is the half meaning of the market. So you have to use both volume and price candlestick charts and just interrelate them. Then you will have a sense and you will have a better understanding of the market. Now how will you do that? I will explain it in the later sections. Volume always indicate the amount of activity going on. Volume is actually the indicator, a leading indicator. Best leading indicator is price, and then the volume is the leading indicator. There is no lag in it. Okay, and then what we do, we see the volume, what's going on in the volume, and we interrelate it with the candlestick size and candlestick type. Okay, and what type of volume is presenting on that. We just look at the candlestick charts, and we look at the volume, and then we interrelate with each other to make a sense of the market, what's going on. Volume is actually the amount of activity going on in the market. So this book will help you in this way, and you will have a live edge at the market after understanding all this concept. Volume spread analysis seeks to establish a cause of price movement, and from the cause they predict the future market. Whenever volume is actually a cause of price action. When there is a high volume, on the candle, the candle has to do something, market has to do something in coming time. So cause is simply the imbalance of supply and demand. Market actually works as market moves with the imbalance of supply and demand, and this imbalance of supply and demand is the cause, and that cause is judged by volume spread analysis method. Then whenever there is a cause, there is an effect. Okay, so this cause which is coming from imbalance of supply and demand, and which actually is created by the activity of professional operators, those who are dealing with the market makers, players. They actually do something, they actually do activity and create the imbalance in supply and demand, and that will produce a cause element, and from that there will be the effect, and the effect might be bullish or bearish move according to the prevailing market conditions. Okay, now in market there are many operators, there are specialists, there are market makers, and we will discuss those market participants in detail here. And there is other main player in the market who is heard, the general public. Okay, now professional players actually operating the market are aware of the emotion that drive you. They know how people react to different, like they react as a herd. Like if there is good news, everyone will be going for buy, pressing buy buttons, and if there is a bad news, everyone will going for sell. So there is an herd instinct in it. So professional players actually know very well this instinct of the common people, common traders, and then they use these emotions in their benefits. They use these emotion in for their own benefits to trade their own account. Okay, how they will do that, we will discuss this. Now, introduction. This is the trading financial market is the world largest business in the world, but least understood business. Okay, now there are many intelligent people, but mostly people fail in trading the financial markets. Almost 90% of traders are on the losing side of the stock market or forex market. Many have a perfect system, very successful system, but their psychology and their gut feel, their psychology is disturbed, their mindset is different, and they still not able to trade profitably even if they have a strong perfect system. Now we will discuss it in there, and if you read this book, you will have these five. If you read this book, you will get answer of these five questions. Why do we have a bull market? Why do we have a bear market? Why do markets sometimes trend strongly? Why do the market run sideways? And how can I profit from all of these movements? So when we read this book, we will get these five answers. Okay. It is interesting to note that the army puts in great effort in training their soldiers, and this training is only designed to keep the men fit and to maintain discipline. Okay, you read this book. Okay, these paragraphs, just read that. So good traders develop a disciplined trading system for themselves. It can be sophisticated or simply, as long as you think it will give you edge. You will certainly need a system that is strictly followed. Avoid the need of emotion. You should have a system that will lead you to deal the market and ignore the total emotion out of it. So trading is like any other professional. Okay, accumulation of knowledge is concerned, but there is where the similarity stops. Trading is a rite of passage. A road will be long, terrain will be tough, you will suffer pain. Trading is not glamorous. You just read this, there is nothing in it. As you gain more experience, you will see markets do in fact move to dictate the supply and demand. Market move with the imbalance of supply and demand. When there is an imbalance of supply and demand, market moves. Imbalance of supply and demand can be detected and read through charts. Okay, then ignore this trade guider setup, just ignore it. Random walks and other misconception. To most people, the sudden movements seen in the market are the mystery. Movements seem to be heavily influenced by the news and appear when least expected. The market usually does the exact opposite to what it looks like. Mostly whenever there is good news, market goes down. When there is bad news, market goes somehow up. So market move mostly against the news. So this is what author is mentioning here. We sometimes observe a bear market in times of financial success and strong bull market in terms of in the depths of recession. When there is a recession time, strong markets appear, and when there is a good time, bear markets. Just read that. There is no anything important, but just read that one or two times. Now, what is the market? Stock market is comprised of individual company shares that are listed in exchange. These markets are composed of hundreds and thousands of instruments. Just go through that, okay? And just go through that. The first secret to learn in trading successfully is to forget about the intrinsic value of stock or any instrument. What you need to concern with the perceived value to professional traders, not the value it represents as an interest in a company. So intrinsic value is only a component of perceived value. So what market perception is what important rather than the actual value of that stock. Okay, this is related to stock market. Just ignore that. You can ignore that. Now, market professionals. Who are the market professionals who actually have some sort of control on the market, and they when they buy, market goes up, when they sell, market go down. So basically they are dictating the market. Who are those participants? Let's discuss. In any business where the money is involved, the professionals are there. We see the professional diamers, merchants, and other players. Financial markets are no different, and professional traders are very active in the commodity and stock markets. These people are no less professional than their counterparts in other areas. Just read these things. Now, it is important to realize at this stage that we refer to the professional. We are not referring to the professional who run the investment fund. Those people who are running investment fund or pension fund, they are not the main players. Okay, at the time of writing, the many investment funds have been making actually losses for the last many years. Some of investment fund companies have even closed down owing to their inability to invest wisely in the market. People nearing retirement are extremely worried as value of their pension plummets further into the doldrums. So they are not the professionals who are running actually the investment fund and the pension. Then who are the professionals? Question is that professionals in the previous example do not live by their trading talent. Instead, they receive a salary from investment or pension or fund company. Yes, they are trader. They are having a salary. They are not relying on their trading talent. So how they can trade the market and give you a profits? So that's a big question, which is just, well, these people will otherwise be homeless. So they are not the smart monies. And then who is the smart money? What do I mean by the professional trader? Well, one example is the private syndicate traders that work in the coordinate groups to accumulate or distribute huge block of stocks or instrument to make similar huge. Now, professionals are those players who have a large amount of money and who have a large balance, and they are actually work in groups. And what they do they actually accumulate stock at certain prices and distribute stocks at certain prices with huge blocks of huge lots or contracts. Okay, and if you in a stock market, then you will say huge blocks of stocks. You can absolutely certain that these traders have made more money from disturbing stocks. So these are the basic major players, the hidden private syndicate traders, and market makers as well, and big banks or big hedge fund managers or big banks or those actually private syndicate traders. They are actually the professional traders, and they are actually the smart money, and they are actually the big fish and the professional traders that are actually profiting from this financial markets, whether forex or stock or whatever. Now, word about market maker. Market maker do not control the market. They are responding to the market condition and taking advantage of the opportunities presented to them. When market move, there is a liquidity. When price moves, there is a liquidity on above, slightly above and slightly down of the current price move. So those pending orders which are actually set up at above current price and below current price are actually dealt by mostly by the market maker, and they actually watching the all the market, and when they see some sort of opportunity or market condition that suits them, they will take the advantage from it, and they don't basically control the market. They are taking the advantage on certain market conditions. Okay, no individual trader or organization can control any market. Market makers are fully aware of the activities of trading syndicates and professional operators. So market makers are actually watching market closely. They have a better resources to watch the market closely. So they actually know that trading syndicates and big players what they are doing and where their substantial orders are. And these market makers are actually trade as according to according to watching those substantial orders and then take the advantage of the market to better than owned accounts accordingly. Okay, just read this. Now volume is the best indicator of the market. If you are not using the volume, you are nothing. You should use the indicator volume. You don't need any other thing. You just need a candlestick chart and a volume. That's it. Volume is a leading indicator, a major indicator. Volume, basically those professional traders, when they active in the market, when they attack the market, when they deal the market, when they that will help us to identify that professional traders are active in the market. So volume is the major indicator of the professional trader. You have to ask yourself why the members of self-regulated exchanges around the world to keep the true volume information away from you. So true volume information, exchanges try their best to keep away or delay their actual volume data from you, because how much important is that? This is the reason is because they know how important it is in analyzing the market. So volume is very important factor. The significance and importance of volume appears little understood by non-professional traders. Many traders trade without watching volume, but that's stupidity. You should have volume on the chart. You should read that volume to in order to be a successful trader. So volume is the basic best indicator. Perhaps this is because they have little information or limited information on the volume. Basically, volume data is similar to buying an to use a chart without if you are trading, if you are doing analysis on chart without volume, then that's like buying an automobile without a gasoline tank. You don't have a gasoline and you are just trying to running the automobile. So chart is the automobile and gasoline is the volume. So you need both things. Volume volume in different analysis, many people use volume, but they use it as an isolation or average it. Okay, analysis, analyzing volume and price of for that matter is something that cannot be broken down into mathematical formula. Reading volume is slightly tough. We cannot make an software and that will help you to read the volume. You just have your own market judgment on the volume. That I will help you in coming my lectures, that how you have to use the volume. This is the one reason where there are so many technical indicators. You just read these all things. Some indicators combine attempt to combine volume and price movement together. This is the better way. Just read that sure to its limitation. Just read these things. Price and volume are intimately linked. Price and volume, candlestick and volume is interlinked. Okay, and the interrelationship is the complex one, which is the reason trade guider, ignore this trade guider stuff, this bullshit. There are frequent quotes on supply and demand in the magazine and newspaper that for every buyer there has to be a seller, and all that is need is to make a market is two willing traders to trade at the correct price. These two quotes are familiar, very popular in the magazine and newspaper, which are unintentionally misleading. Actually, these two sentences where you listen, heard about that, these are actually misleading. These statements sound so logical and straightforward that you might read them and accept them immediately at face value without ever thinking about the logical implications. You are left with the impression that market is a very straightforward affair, like German open auction at these are in fact very misleading statements. These two statements are very misleading. Yes, no, you may be buying today or somebody may be selling today to you. However, you might be buying only a small part of the large block of sell order, and that may have been market maker books sitting there well before you arrive on the scene. These sell orders are stock waiting to be distributed at certain price levels and not lower. So players basically, what they do, they actually accumulate stock. They buy a large sum of stocks, large sum of contracts of different instrument, and then when price goes up and then after the bullish rally, they actually distribute, sell those holdings which they have on the lower rates. And for that, they don't do that at once. They slowly do that, and when they slowly do that, that's called distributed at certain levels and not lower. Okay, so the market will be supported until these sell orders are exercised. So player who have holding or who have buy contracts and the market completed the bullish rally, then they actually are selling in the market because they think that now top is near, so they are selling the market. So when their sell orders are still there, they will support the market and will keep market on the top. That's why mostly we see that top consolidation on the top and consolidation on the bottom. Basically, consolidation on top means distribution phase, and consolidation on bottom phase accumulation phase. Accumulation phase mean big players actually buying in the market, taking the supply from the market, and distribution phase mean the big players are actually selling in the market, basically giving supply in the market, and that results in the downside of the market. So at important point in the market truly may be very that every share you buy, there might be 10,000 share to sell. So when you buy, you have, it's not a necessity that someone is of equal amount is against you and is selling. No, there are many sell orders in front of you. You are just one buyer. Okay, so their sell orders needs to be distributed. So market does not work like a balanced weight scale where adding a little one side tips the other side, and market is not in a balance, it's not a straightforward affair. Okay, you frequently hear of a large block of stock between professionals bypassing what appears to the usual routes. My broker, this is, you read this all thing. One told me to ignore the very high volume seen in the market that day, because most of the volume was only among market makers do trade among themselves sometimes, adjust their position. One player is buying, one player is selling, and there is an there is a transaction which is very heavy, but those transactions are done by among the players, so that will not majorly impact too much to the market. But you should never ignore the any abnormal volume in the market. Whenever volume is high or ultra high, very high, never ignore it. It's the indication of the player which is active on that particular stage. So you should watch closely volume surges in other markets, and to that which you are trading. So it means you should focus on the future market as well. If you are trading stock gold on spot, then try to check the future market of gold and how the volume reacting there, and then you can interrelate with that, because future and spot mostly move similarly. So when you do analysis on future, and when you have some abnormal factor there in high volume case, then you will trade accordingly in the spot market. So volume is the activity, and you have to ask yourself, smart money active right now? So volume, whenever there is a high volume in the market, whenever there is a spikes of volumes in the market, it means volume, smart money is active in the market. Further understanding the volume. Volume is not difficult to understand once the basic principle of supply and demand are understood. The volume is not very difficult to understand. Okay, so we just need to relate the volume with the price action. Volume is the powerhouse of the stock market or forex market or commodity market. Okay, now when you start using volume, then you will start to trade on the facts, not on the news. Normally people see what on good news people look for buy, on bad news people look for sell. That is the instinct people have, and that's why they are 90% failed traders. So when you use the volume, basically you will start to trade on the facts. Your trading will become exciting as you start realizing that you can read the market. Precious, this is a very precious skill that you have, that only few people share with you. Okay, to say that the market will go up, there is more buying than selling. Whenever market is going up, you just have in your mind that there are more buyers than sellers. There is more buying than selling, and that means demand in the market. And when market is going down, there is more supply than buying. So market have more supply than demand. That's why supply is overruling on the demand, and the imbalance actually shifting market towards the downside. So that is basically the formula of the market, that when there is more buying in the market, it creates the demand, and demand overrules on the supply, and the imbalance of supply and demand, where demand is on the higher side, will actually make the market towards the upside. However, to understand this statement, you need to look for the different principles. To understand what volume is saying to you, you have to ask yourself, what has the price done on this volume? You cannot read the volume in isolation. You have to read the volume, and you have to check the candle. Candle is bearish or candle is bullish, or upper wick, how a candle is formed, upper wick, lower wick, the size of the candle, spread of the candle, range of the candle, and how volume is interrelating with that sense. Like volume is high, low, or very low or very high. So these are the interrelation of volume with price, and you will make sense out of it. Spread is basically difference between highest and lowest point of the time frame you are using, whether weekly, daily or weekly. Spread is actually the difference of simply spread is basically size of the candle, simple as that. Volume shows the basically this book actually using the bar chart, but I don't recommend you to use the bar chart. I will use candlestick charts for you. Okay. Volume shows the activity of trading during a specific period. If the volume is taken in isolation, it means nothing. Volume is basically the activity in particular time, trading hour. Volume is the activity, and if you just use the if you just read the volume in isolation, then it's nothing, it mean very little. Okay, you have to use it within relative term, like today volume with tomorrow, yesterday volume, today volume with 2 days ago volume, today this hourly volume with previous hourly volume, this 5 minute candle volume with previous 5 candle volume. So you have to relate the volume with previous 10 to 20 volume bars, then you will have a sense on it. So you have to compare the today's volume with previous volume 30 days. Whenever you try to read the volume, you have to judge whether it is high, whether it is low, whether it is average, and to judge that you have to relate it. How you can relate it? Just look at the previous volume, previous 10 to 20 volumes. Okay. One second. Let me open here. Let me open here the chart. So I can help you in understanding the market. Wait a second. Now this is the volume. This is the volume. You are watching this volume here. This is below, histograms are the volume, above is the candlestick chart. You just need this thing, the candlestick chart and the volume on the lower side, histogram. So that's it, you just need this. So these are the volume. Now when we read the volume, we have to judge whether it is high, whether it is average, or it is low. We need to judge that. So how we can judge that? If we say that whether it is high, whether this volume is high, low, or average, we have to compare it with previous 30 volumes. 1, 2, 3, 4, 5. I mean previous 30 volumes. We have to compare it with previous 30 volumes. These are volume. Now you can see that if we compare it with previous 30, 20 to 30 volumes, then this is a high volume. So basically we can say that this is an ultra high extraordinary volume. We can say that it is a ultra high volume, extraordinary volume. Okay. So that is author actually saying that we cannot judge volume individually. Okay, we just ek, wait a second. Wait a second. I'm back. Actually, I am trading myself as well, so that's why. Now, hello, everything is clear. Oh, okay. Now, if you compare today volume with the volume on the previous 30 bar, then you will realize that whether volume is high, low, or average compared to the volume seen in the past. I told you that when you will compare one volume with previous bars, when compare this volume with previous 30 candles, then this is the high volume. This volume is the high, extra high volume. Okay, and we call it as high volume or ultra high volume. Okay, now, so if you stand 30 people in a line, it is easy to understand, see who is the tallest compared to the others. So this is a skill of human observation, and that skill you have to apply when you are actually judging whether volume is real, high, low, or average. In volume spread analysis, in volume method, we use candlestick charts and the volume histograms. And what we do, we see the size of the candle, closing of the candle, wick of the candle, and the volume, whether it is high, whether it is low, whether it is average, whether it is very high, whether it is very low. These five categories. So how we can judge that this volume is on which category? We just compare it with the previous 30 candles, and if that is high than the previous 30 candles, it is a high volume. If that is abnormal, normal volume like this one, this is a normal volume like this one, this is a normal volume. So we can say that this is a normal volume because this is an average volume. And when we say that what about this volume, then we can say that this is a low volume. This volume is low volume. Okay, so this is a low volume, this is an average volume, and this is an ultra high volume. Okay, okay, compare this volume information with the price spread, and you will know. Compare this volume information with the price spread. Now what you have to do, you have to do what you have to do actually, wait, compare this volume information with the price spread and you will know whether market is bullish or bearish compared to the professional wholesalers really are. Basically, okay, when you will read the volume and link it with the price range or price spread, then you will have an idea that what big players are doing in the market, whether they are bullish or bearish. This is what author is saying. So basically what the author is saying, that when we read these candlesticks and link that with the associated volumes on the lower side, then we have a sense and we have a feeling and we have a judgment that what players are doing here, whether they are bullish or bearish. And when they are bullish, we will also trade towards the bullish side, and when they are bearish, we will also trade to the bearish side. So we will align our trading with the market players. Okay, to make it easier you to understand the volume, compare it to the accelerator of the automobile. Like an accelerator, think about the result you will expect by pressing. Just read this thing. Okay, just read this thing. Just read this thing. Okay, so you may be disbelieved that your instrument are telling you. Okay, many traders are mystified if the same thing happen in the stock market. Remember, any market, just like automobile, has momentum that will cause momentum even when power has been turned off. Just read these things. You have to read this book 3 to 4 times, then go for my other lectures. Okay, now what is the bullish volume and what is the bearish volume? Okay, just read all this thing. Bullish volume is increasing volume on up move and decreasing volume on down move. Okay, bullish volume is increasing volume on up move and decreasing volume on down move. Author is saying that look, price is going up, price is going up. Volume, what volume is doing? Volume is also increasing. Okay, and when price is going down, look at this, price is going up from here, price is going up, and what volume is doing? Volume is slowly picking up, volume is increasing. Whenever price is going up, whenever candlesticks are going up, whenever candlestick charts are going up, and volume is also increasing, that's called bullish volume. And when price is going down, like that, and volume is decreasing, that is also called bullish volume. So there are two cases. In one case, price is going up, candlesticks are going up, and the volume is also increasing. That is called a bullish volume. And part B is when price is going down and volume is decreasing, that also called volume, that we also call bullish volume. So when market is in bullish volume behavior, it means that big players, the big fishes, are in the bullish side. Okay, so that is the meaning of bullish volume is increasing volume on up moves and decreasing volume on down moves. Bearish volume is increasing volume on down moves and decreasing volume on up moves. Now what about bearish? Let me tell you what about bearish. Now look, market is going down and volume is increasing. That means it is a bearish volume. When market is going down and volume is increasing, that we call it as a bearish volume. Okay, and in other words, when market is going up and volume is decreasing, that is also a bearish volume. Two parts. One part is when market is going up and volume is decreasing, it we call it as bearish volume. Market is not strong, market is weak because volume is not participating. And when market is going down and volume is slowly increasing, we call it as an bearish volume because market is actually participating into the move. So there are two volume behaviors: bullish volume, bearish volume. What bullish volume is? Bullish volume is when market is going up, then volume is also increasing. That means smart money is actually participating in that move. And volume, when market is going down, market is restricting their orders. Market is volume is drying up. That means market is not interested in the downside moves. And the bearish volume, what is bearish volume? When market goes down, then volume is increasing. It means market is interested in downside moves. And if market is going up, volume is dried or low, then it means market is not interested in up moves. So we call these two things, that what is bullish and what is bearish volume. Now read this all thing. This all thing, you will have an idea what I told you. They are actually trying to tell you this the thing which I told you. Okay, so volume activity is automatically calculated, and ignore this. I told you ignore this trade guider software, just throw it away. Okay, if price are dropping on volume that is less than the previous two bar, the price is there, ignore that. Just read these two things, I will discuss it later. And now accumulation and distribution. Syndicate traders are very good at deciding which of the listed stocks or shares worth buying. They know which instrument to buy and which are the best or left alone. So they decide to buy the stock or instrument, whatever, of gold, oil, silver, or any currency or whatever instrument they have. They want to plan. They actually first plan and then launch, like military precision. They do a campaign to acquire the stock, and they do the accumulation, and then when they are interested in selling, then they do the distribution. What accumulation is? Accumulation is that players, big players, when they make a range, big players, when they make a range, okay, like this range, this range, okay, when they make a range, then they slowly buy on dips. Market goes up, then goes down, then they buy on dips. Then they buy too much that they actually disturbing the demand and supply imbalance. And when they buy too much instrument on this range, then what will happen? Demand slowly goes up, and demand actually overrule to the supply. Demand actually push the market towards the upside, and because big players are actually buying the market in the strong hands. So after this phase is called accumulation. Okay, and what about distribution? When price goes up, what about distribution? Let me tell you, this is also accumulation. Look at volume on dip. This is buying. This is accumulation. Market is going down. Professional players are active in the market and they are buying there. Again, market going down. Again, high volume. High volume is basically the indicator of the big players. So this is accumulation, and let me tell you the distribution phase as well. Now when market goes up, then they do distribution like that. They move the price to through up down, make some range, and they sell on every jump. They keep selling. Then what will happen? Market actually move with imbalance of supply and demand. When they sell, they actually hitting the supply in the market. They are pushing the supply in the market, and when market have enough supply, market turns from bullish side to bearish side. So this is the concept of this accumulation and distribution. Just read that, you will get an idea of it. Strong holders and weak holders. Just read these things. Stock market involves the accumulation and distribution, which are process. Strong holders are usually those traders who have not allowed themselves to trapped into the poor trading situation. They are happy with their position. They will not be shaken out with the sudden move down or up. They are not trading on news. They know the right side of the market. They have better resources to read the market, so they have better planning on the market, and they have better position on the market. They have very protective stop losses. They know where they should put the stop loss, and they quickly close their trades if they close their trade if their trade goes wrong. And they are very smart, so they are smart investors. They are not herd or public, they are strong holders, so market cannot trap them easily. So these are strong holders. And what are weak holders? Weak holders are we public we are public is weak holder. Wait a second. Now weak holders are actually most traders who are new to the market will be easily become a weak holder. New beginners, these people are usually undercapitalized. They have small amount of balance, cannot readily cope with losses, especially if most of their capital is rapidly disappearing. They have emotion decision making. Weak holders are on the learning curve and tend to execute trades on instinct. They just see news. When the news is good, they buy. When news is bad, they sell. They've been shaken out easily by the players. Okay. Now, a bull market occurs when there is substantial transfer of stock from weak holder to strong holder, generally lost to the weak holder. When bull market occur, bull market occur when players are buying and public is selling. When players are buying and public is selling, then bull market occurs. How it occurs? At accumulation. Like let me tell you, when market goes down suddenly, when markets goes down, there is a bad news. What public will do? Public will actually sell. Players know the actual side of the market. They actually buy against them. They buy. So what's happening there? They are happening that the substantial of transfer of stock from weak holders to strong holders. So that is actually meaning of accumulation, and after accumulation, a bull market is evident, is near. Like, and on distribution, when there is a distribution, then bear market will come. On distribution, what's happening? Substantial transfer of stock from strong holders to weak holders. Basically, players are selling in the market at distribution phase. So that's why bear markets comes in. Just read this buying climax thing. Just read this thing. Buying climax, imbalance of supply and demand, and buying climax, then selling climax. Buying climax, a balance of supply and demand causing bull market to transform into a bear market. If volume is seen exceptionally high by a narrow spread into a new high ground, you can assure that this is a buying climax. Let me tell you how buying climax is. Let me tell you how buying climax is. Let me tell you how buying climax is. Wait a second. This is a buying climax. This candle is buying climax. A large candle, not very low range candle, slightly not very large, normal candle with an upper wick and closing in the middle, green candle and extraordinary volume on it, and the following candle down. This is a buying climax candle. Okay, so basically author, what he will explain, he will actually explain that this bullish candle and with an ultra high volume, and then market goes down, and this is actually the start of the distribution phase. Basically this is the first punch from the big players that they are actually selling in the market. How it will happen? It will happen when there is good news. When there is good news, market suddenly goes up and then slowly goes down. When there is good news, what public will do? Buy. Then what player will do? Player will sell, getting the candle to be close to the middle and upper wick, and then market will return to the downside and start of the distribution phase. So you will read that selling climax is the opposite thing. Selling climax is the opposite thing. It is actually the start of the accumulation phase. Let me show you the selling climax as well. Let me show you selling climax as well. This sell candle is the selling climax. Look, the volume is high than previous 20 candles. Volume is high than the previous 20 to 30 volumes. So this is the selling climax. Closing is mid. Closing will be better if it is in the middle. Okay, then market goes up. So this candle with high volume is actually a selling climax, and it is actually a license of it is actually the indication of start of the accumulation phase. Now gold should accumulate there and then go up. Okay, there may be a multiple climax. This is also a selling climax. This is also a selling climax. Exactly. You can have 2-3 selling climax collectively. You can have 2-3 selling climax collectively. When they appear, it means the start of the accumulation phase. Market will accumulate, and then finally when market is ready, market will go up. Okay. Now let go further. Resistance and crowd behavior. Just read that. Just read this thing. Herd is normal public. We call public and herd because they have emotion. Like they will panic after observing substantial fall in the market. Like market suddenly goes down on bad news, they will panic, and they will actually sell. They will sell into the market because they are panic. So this is the crowd psychology. You must ask yourself that whether this drop, what are professional trader and market makers doing in this sudden drop? What players are doing in this sudden drop? They are actually buying in this drop, panic selling. And if the player are doing, and how you will judge that? You will see the volume, and when volume is high, you will know that players are active in the market. Basically, how we can read players are these high volumes areas are actually the footprints of players. So when there is a high volume, we say that players are active in the market. So this is what he is trying to say. And after substantial rise, herd will in point 1 they actually author is trying to tell you that how people goes to the panic stage and they will sell. When they sell, the player absorb their selling by buying against them, and then market takes its strength on the market. That's why on bad news market goes up after dip, and when there is a good news market goes up, everyone buy. Then what player syndicates are doing, they are actually selling into the market, and then this is the sign of the weakness. A professional trader himself isolates himself from the herd and become a predator rather than the victim. He understands, recognize that the principle drive the market and they refuse to mislead by the good or bad news. Players know what's going on in the market and they don't get misled by good or bad news. So that's why mostly market go against news. When there's good news, market goes down. When there is bad news, market goes up. When the market is being shaken out on bad news, he is in there buying. When the herd is buying, the news is good, he is looking to sell. Just read these all things. Now, supply and demand. What is supply and demand? Supply and demand, just read these all things, okay? This is simple concept, supply and demand. You just read that. Okay, when there is more sellers in the market, that's we call it as supply. When there is more buyers in the market, we call it as demand. Just read that. I don't waste my time. Relax. I will go to charts. I will tell you strategy. Just read this book 2 to 3 times. That's I want. Just go through that, the basics of market reading. You just need you don't need this software. This is a bullshit. And you don't need this bar chart. You just need this candlestick chart, and you need this volume in the low. That's what you need. Okay, you need MT4, and you need on MT4 candlestick chart and the volume in down. Which broker is best for to read to read because volume is different, sometimes different in different brokers. So which broker is best, who have best data feed of volume? So I recommend you XZtrader. XZtrader is better. So better to go to their website and make a demo account and log into MT4 and just watch monitor volumes on mobile as well. Just read this thing. Okay, just read this thing. All market moves in phases. Okay, we can observe the market cause of the next move. These phases may be last in few days or few weeks. Longer the phase give you, the larger the moves. The amount of volume taken in isolation mean little. Individual volume means little. Like simply this individual volume is nothing. We have to relate it with the previous 2 3 volumes or previous 20 volumes. Then we will have a sense there. Okay. I ignore this trade guider thing. This software trade guider, ignore that. Now this is the spread. Spread is size of the candle. Range of the candle is called spread. I mean this is the range. Let's suppose this is the range of the candle and we call it spread. Simple. We have to use candlestick chart. We don't use this bar chart. We will use candlestick charts. Just go through that. How to tell if market is strong or weak. Just read these things. Okay, you will know better what's going on. Okay. By reading the candle, we are actually watching the behavior of the professionals and market makers. What are their opinion about the market, which side they want market to go. Okay, so that's very important. We read the sentiment of the market makers through the candlestick charts and then relate it with the volume. Then we will have a sense. Just read this thing. Just read this thing. You have to read that. Yeah, read all this stuff. How to identify buying and selling. Okay, yeah, read these all things. You have to read this book 2 to 3 times. How to identify lack of demand. Just read this thing. You have nothing very special. Testing supply. Just read these things. You have to read this book 2 to 3 times basically. Read these things. Pushing through supply, that's very important topic, that when market is in a range bound stage, then suddenly market goes up. What is the phenomena behind that? You just read that and you will have an idea upon that, and volume increase on that scenario. High volume on tops. Yes, high volume on tops. Whenever you see in the market, you will see that high volume on tops. Look at this, high volume on tops, high volume on tops, and and high volume on bottoms, because players are active on the extreme level of the market. Players sell on the high and buy on the low. That's why these volume spikes are actually the high low, on top and on bottom. We see these high volumes on tops and bottoms, because on tops player is active and they is selling, on bottom player is active and actually buying. You read that stuff. So effort versus result, read these things. Path of least resistance. If selling has decreased on down move, the market will then going to up, no selling pressure. Just read this thing. Market can be marked up or down. Sometime big players, they have the capacity to push the market to wrong side, like fake down moves or fake up moves. They have the capacity to do that, and that we call that mark up or mark down. Just read that. Volume surges in different market, you just need to read that. Using different time frame, read that. Relationship between cash and future price. Future price very important. If you're trading on gold, you have to keep eye on the future market volume as well. So you have an understanding there, and you can apply that on cash market as well, spot market as well. Manipulation markets are, almost every market is manipulated. So what's going on there, about the market manipulation, you can read that. Now there is introduction to trends, just read that. Trends basically successful, consecutive lower highs and lower lows is in downtrend, consecutive higher highs and higher lows is an uptrend. Simple as that. Just read that. How to plot a trend line, just read that. Bottoms and tops, you have to just read this book 3 to 4 times. I want you to read this book 3 to 4 times, that's it, and then throw it away. Just read this book, read this thing, read all that stuff, that what's going on this trend channel, what's going on these channel, and what different traders are doing there. You just read this book, what A is doing, what B is doing, what C is doing. These are the different possibilities and what their expectation is. One is in panic, one is in good short position, one is actually showing having a small loss. So how we will deal that situation, and what what will happen next, or what author is trying to say. Okay, so just read that. Introduction of class trend clusters, just read that. Just read that. I go too much away. Introduction to clusters. There is no nothing important in that. Just read this book one time. Volume. Whenever you see the market test the trend line, then there is a high volume. Basically players are active at that stage, and when price reject from the trend line, and mostly on a high volume, when there is a decrease in volume, what is the meaning of that? You just read that book and you will get idea of it. And when price break this trend line, then volume will increase. And what will happen after that, or how market behaves there, you just read this book. Pushing through supply and support lines. Just read this book and ignore this bar chart. Consider it as an consider it as an candlestick chart, and just understand in that way. Wait a second. Just read this book complete. Now how this channel is operating, and this volume is how author is reading this volume, you will understand a lot of thing there. Just read these all things. Then what start a book bull market, that was like one of the question, and he actually answered that. Just read that. How campaign started, how they start the campaign. Just read these things. Then there is an upthrust thing. ठीक है, one of the favorite indicators uh, uh, of VSA. Just read these things. Buying climax, selling climax. Just read these things. You have to read this book 3 to 4 times. Then you have another topic, stopping volume. Just read that. What is that? Falling pressure. Be aware of news. Just read this book. You need an system. Read this book. read this book till let me tell you, that's it. You have to read this book till 117 page. That's it. Okay, you have to read this book 3 to 4 times, and till 117 page. Okay, ignore this chapter, trade guider system and stuff. Ignore that thing. We don't need any software. We just need a simple chart, whether it in a trading view or MT4. That's it. So basically you need to how you can download this book. Simply go to Google. Go to Google, write master the markets, master the markets Tom William PDF, and just click any link and you will download that book. You can click any link and you will get it. Just read this book 2 to 3 times. 2 to 3 times. That's it. 117 pages. 117 first 117 pages. Ignore last 60 to 70 pages. Read this book and then move to my next lecture. Then I will tell you what you will do next. I want you to become a good trader, and how I will guide you. Just follow me, and you will but trust me, you will be on the better side. Okay, thank you.